Hi, it's Andy Hoffman, Media Director of Miles Franklin Precious Metals, celebrating our 25th year in business. It's midday, Friday, May 9th, and this week's audio blog is titled Fed Failure for the Entire World to See, and with good reason, as this week we witnessed, per the title of yesterday's must-read piece, the most damning proof yet of QE failure. Frankly, it seems like new lows are observed each week, not just in political, economic, and social deterioration, but the degree of money printing, market manipulation, and propaganda utilized to mask it. And this week was no exception, as the predictable intervention surrounding Whirlybird Janet's congressional testimony combined all aspects, as the global tragedy, that is the US dollar anchored fiat currency regime, enters its final act. Recall last Wednesday when the Fed announced an increased taper in its policy statement, despite continuing to anticipate zero interest rate policy, or ZIRP, until at least 2015. Coincidentally, while Yellen spewed the latest propaganda buzzword of recovery, interspersed with the equally malignant propaganda scapegoat of the weather, the BEA was reporting GDP growth of 0.1% in the first quarter. And by the way, following subsequent downward revisions in durable good orders and the trade deficit, it now appears the final GDP number will be negative. Alas, the recovery. Better yet, just 2 days later, perhaps the most disastrous NFP employment report yet was published, as the entire world was able to see, unequivocally, how fraudulent the BLS numbers are and how weak the true state of the U.S. labor market is. Heck, despite the so-called massive 288,000 job gain reported, Janet Yellen said in yesterday's congressional testimony that a, quote, high degree of monetary accommodation remains warranted as many Americans who want a job are still unemployed. I described the employment carnage in another must-read article last week, titled Three Numbers, plus 288,000, plus 234,000, and minus 806,000. And in future months, anticipate the horrific trends in labor participation, job quality and wages, and data manipulation to dramatically deteriorate. Frankly, it's amazing how much market manipulation can influence perception, at least in the short term. As for as long as I can remember, employment was considered the holy grail of an economic recovery. And now, from the US to Europe to points east, employment trends, job quality, and wage growth have never been worse, at least not in any of our lifetimes. To wit, in yesterday's Bank of England policy meeting, in which both ZIRP and QE were maintained indefinitely, Bank of England Governor Mark Carney, yet another former Goldman Sachs partner, said that although the unemployment rate recently dropped below the 7% level previously cited as the threshold to end ZIRP, they will instead maintain it indefinitely. In other words, exactly what the Fed did, and for that matter, why the BLS waited until just this month to, quote, release hundreds of thousands of people from the labor force, thus enabling the unemployment rate to plunge from 6.7% to 6.3%, ironically amidst a 35-year low in the labor participation rate. As for today's title, the Fed failure I'm referring to was first discussed in Wednesday's article titled 2.6% Nuff Said, and articulated further in yesterday's article. However, to fully appreciate it, one must go back to my January 10th prequel titled 3.0% Nuff Said. In it, I postulated that the Fed was tightly managing interest rates despite their so-called goal of creating a self-sustaining recovery that would enable rates to normalize. In other words, despite saying they expected higher rates, they were determined to do anything to prevent the benchmark 10-year yield from breaching the key round number of 3.0%, such as recruiting Belgium to buy $200 billion of treasuries when the Fed supposedly was tapering. Common sense will tell you that rising rates in a highly indebted nation, and the world for that matter, would be catastrophic. Not to mention to the Fed's $4+ trillion portfolio of high duration treasury and mortgage backed bonds. However, the MSM conveniently ignores such an enigma so long as stock and real estate prices were rising, which right now is not the case, particularly regarding real estate and speculative small cap stocks. And thus, the urgency to keep rates from rising has been strengthened, particularly now that food prices are exploding higher. U.S. food prices, for example, are up a whopping 20% in the last 4 months alone. And with the California and Brazilian droughts showing no signs of abating, much less easy monetary policy, who knows what will happen in the coming months to prices. Last week, I spoke of Safeway, the nation's second largest supermarket chain, saying that starting now, it will be passing through most of the costs it has been eating for some time. And this week, I direct you to an interview with the CEO of Landry's, one of the nation's largest restaurant chains. In it, he addresses everything from raging food inflation to the expanding socialism I recently wrote of in Socialist Economics 101 to the exploding costs of doing business in California, as I recently wrote of in California inflation. And if you don't think what I'm describing is dire, then check out this quote that he gave in the interview. We have an inflation problem right now. The cost of food is going nuts. Back when I was public, and even today, they'd ask me, what are you going to do about costs? And I've always said, have you ever seen a restaurant put a sign up saying, going out of business due to high food costs? But right now, today, everything from a lime to coffee to shrimp to beef, every single thing is hitting us at once. And labor, just right here in California, you're putting in the new minimum wage come July. Just me, and I have 70 or 80 restaurants in California, I have 3 million more of labor costs. I have no problem with raising the minimum wage, but in turn, customers can't say, why are you raising prices? Everything is fair, but the consumer is going to notice. From going to the grocery store to going out from dinner to dinner, they're going to be paying more for a meal. Anyhow, there's not a doubt in my mind that originally, tapering was nothing but a propaganda scheme to make the world believe the Fed wasn't a perpetual money printing machine, accomplishing nothing but inflation and wealth inequality amidst an at best lukewarm economic environment. Or better yet, a depression if one were to use unmanipulated GDP, inflation, and employment figures. Not to mention, the soon-to-be departing Bernanke had literally spent the entirety of his 8-year term lowering rates and printing money, and thus was desperate to leave on a so-called good note. In proof of the tapering mirage, I unequivocally proved they were printing closer to 130 billion a month from May through December, as compared to the 85 billion they said they were printing and monetizing. And when the tiny nation of Belgium, where the EU just happens to be headquartered, showed up in trade figures as a buyer of a whopping 150 to 200 billion of treasuries in the first quarter, it became crystal clear that they weren't tapering then either. Heck, the PBOC in November said it was, quote, no longer in China's favor to accumulate foreign exchange reserves. And following that, in December, they sold a near record 49 billion of treasuries in December. And there were a record 104 billion of total foreign selling of treasuries in just 1 week in March. However, as I wrote yesterday, a funny thing happened on the way to the Eccles building, which, FYI, is where the Fed is headquartered. Despite all that foreign selling of treasuries, treasury yields continue to ratchet lower. Sure, the Fed was clearly offsetting much of the selling with covert buying, but enough so to actually cause rates to plunge? Something weird was up, that is, until one realizes the 2013 holiday season, following a year of full-blown QE3, was the worst since the 2008 crisis. And whilst first quarter GDP was likely negative and labor participation at a 35-year low. Worse yet, such trends were no different in Europe, China, Japan, or even China, the latter of which appears to be in the early stages of an historic bubble bursting. And thus, it suddenly dawned on the Fed that what's left of the market was calling them out on their so-called tapering plan. Clearly now aggressively buying treasuries under the assumption the economy is in fact tanking and thus further QE upcoming. The same thing is occurring in Europe, particularly in PIGS bonds, at multi-year highs despite multi-year economic lows, and of course Japan, where no one will sell a government bond. knowing full well that Abenomics is committed to buying every bond in sight. And thus, just as the Nikkei's early 2013 gains, when Abenomics was announced, have been threatening to break down for months, the 10-year bond yields gained last spring when tapering was first mentioned are now threatening to be lost as well. Thus, it's becoming quite clear that, like the cartel defending $1,300 gold, or as I call it, battlefield $20 silver, the Fed is now indeed tapering, and doing so with a vengeance, but unfortunately for the completely opposite reason they had hoped to initiate it for. In fact, I'd be shocked that if I write, the Fed is not actively selling some of its treasuries to prevent the, quote, downside line in the sand at 2.6% from being breached, thus exploiting the aforementioned Fed failure for the world to see. As discussed in my last 2 days' articles, the most damning proof yet of Fed failure and 2.6%, enough said. Not to mention today's article to be published shortly, titled "'Twas the Night Before QE Infinity." As for gold and silver, prices are so far below the cost of production, global demand is surging, while production has clearly peaked en route to inevitably plunging. We have now seen backwardation in gold for a record 3 straight weeks, and even the 1-year rate is close to backwardation. And of course, those record U.S. mint sales of silver eagles, despite paper prices being maniacally held so low. Emphasizing the point, one of the largest primary silver miners, Yellen, just reported a $37 million loss in the first quarter, while realizing $20.29 per ounce silver. I believe that the cost just of getting break-even earnings for the industry is closer to $25 an ounce and perhaps higher, and certainly above $30 an ounce if you're talking about replacing reserves in a dramatically depleting, high-cost industry. Well, that's enough for today. Hopefully you're starting to realize that the reality of the world is far different than what the money printing, market manipulation, and propaganda scheme is telling you. Chinks in the armor are showing everywhere, such as the fact this week that the Fed actually is trying to support interest rates to protect its view that we're in a recovery. And it's only a matter of time that, like all the other fiat Ponzi schemes before it, this one too collapses. This is why you need to consider protecting your net worth now while there's still a chance. And if you do, as always, we hope you call Miles Franklin at 800-822-8080 and give us a chance to earn your business. And as always, you can contact me personally with questions at ahoffman@milesfranklin.com. Thanks and have a great weekend.